So what's up with the stock market in 2022? The S&P 500 is down 13% in January alone. Nasdaq is down 19% in January alone. So what's to come for the rest of the year? So a lot of people are asking, hey, have the fundamentals of these businesses changed? Have the fundamentals of the economy changed? And is the bull market dead? And what can I expect for the rest of the year? So let's answer all these questions in this video. So since the start of the year, the market looks like it's dropping like a stone. The S&P 500 is down 13% in January alone. And if you look at the Nasdaq, which contains mainly the technology stocks, that has been whacked even harder. The Nasdaq is down a whopping 19% from its recent highs, almost hitting the 20% threshold of being defined as a bear market. Now, how about individual companies? If you look at Microsoft, for example, Microsoft is down 8% from its highs. If you look at Alphabet, or Google, as we like to call it, is down 18% from its highs. Again, almost at that 20% threshold. And if you look at Adobe, Adobe is down a whopping 31% from its highs. So the question to ask is, hey, have the fundamentals of these businesses changed? And the answer is no. I mean, think about it. Microsoft today and Microsoft last month, it's the same exact business. Sorry, it's not the same business. In fact, sales have been growing, profits have been growing. If you look at, again, Apple and Microsoft and Google and Adobe, it's the same darn company. So why is the price 20% different or 31% different? It's all market manipulation by market makers and algos. And I'll talk about that in a while. Now, there are some company stocks that deserve to drop because they were overpriced, they don't make money. For example, if you look at stock like DocuSign, or you look like Teladoc, for example. I mean, these are stocks that deserve to go down, right? Because they're not making money. They were inflated purely by hype, in my opinion. If you look at companies like in DocuSign, see, all these companies are not making money. They're not making a freaking cent, right? So they deserve to drop 20, 30, 40, 50%. But for companies like Microsoft and Apple and Google and Facebook and Adobe, sales are growing, profits are growing. Nothing wrong with the business at all. It's the exact same business. The prices are dropping purely because, again, of manipulation, and it's being thrown out. The baby's being thrown out with the bathwater, which are all the lousy other companies that deserve to go down. So if you are holding to fundamentally great companies that are profitable, no worries. Nothing has changed. It's the exact same company. The price movement is manipulated, and very soon you'll be back to all-time highs for those companies. Now, is there anything wrong with the economy? Absolutely not. In fact, the economy is doing really well. The macro factors are extremely strong. If you watch my recent Outlook webinar, you know me saying that, okay, so GDP is projected to grow at 3.5 to 4% this year. If you look at it, wages are up, unemployment is going down, consumer demand is going up, and households have one of the lowest debt servicing ratios in history. So the consumer is in a good position, the economy is strong, and if you look at companies are still growing. Again, those that are profitable, those that are not profitable, they deserve to drop because they were being held up purely by hype. But those companies that are making money, they will continue to make money this year. S&P 500 companies are projected to grow at least 8% earnings growth this year. I also mentioned in the Outlook webinar that, hey, stocks are not expensive. In fact, with the recent added drop in the last few days, stocks are getting cheaper. If you look at it again from the PE ratio perspective, now the current PE ratio of the market is only 25 times. If you take a look at the last 10-year average PE ratio, it's about 23 times. So in other words, the market based on historical PE is fairly priced. I mean, it's not cheap, it's not expensive, it's fairly priced. So when people are calling for another major crash or bear market, I don't see that happening right now. Because nothing wrong with the economy, stocks are not that expensive. And again, I've also mentioned that, again, relative to bonds, stocks look damn cheap, especially now with the recent drop in stock prices. So with the recent drop, the S&P 500 is now yielding 4%. It's got an earnings yield of 4% versus the bond market, the 10-year treasury bond, that's yielding 1.8%. So stocks are a lot more attractive as compared to bonds. You can expect the bull market to continue. If you think about it, the only thing that really can predict a recessionary bear market in history is the inversion of the yield curve, when the yield curve inverts. Now, even when the yield curve inverts, a bear market doesn't happen immediately. In fact, when the yield curve inverts, the bear market could come in 3 months or 6 months or whatsoever. So you can't really time it perfectly. But right now, the yield curve is not inverted. In fact, the yield curve is healthily sloping upwards. So no signs of any kind of recession on the horizon, right? And again, people are freaking out because they're saying, hey, the reason the market is melting down, Adam, is because of the fear that the Federal Reserve is going to increase interest rates. Now, again, don't buy that bullshit reason. You know, I always say that manipulators, market makers, and all these algos, they use this kind of news as an excuse to push prices down and to scare away retail investors, to throw out all the retail investors before they push it up again. Because if you take a look fundamentally, rising interest rates are actually bullish for the stock market. Hey, take a look at history. I've talked about it in the Outlook webinar. Let me say this again. So if you take a look at the last 20 years, you can see that stock prices and interest rates actually trend in the same direction ultimately. And again, if you take a look at the blue line, that's the short-term interest rates set by the Federal Reserve. When they raise interest rates from 3% to 6%, that's a rate hike cycle. What happened? The stock market went up. When they raise interest rates from 4.5% to 6.5%, stock market went up. When they raise interest rates from 1% or less to 5%, the stock market went up. When they raise interest rates from 0.25% to 0.75%, the market went up. Now again, when interest rates rise, stock markets go up, not all stocks, okay? Only stocks of profitable companies. Again, companies that are not profitable, stay away from those because those may never come back if they don't start making money. So again, remember. Now again, the other thing that's freaking people out is they're saying, hey, it's not the short-term interest rates that are crashing the market, it's the long-term 10-year yield or the 10-year bond interest rate that has been rising like crazy. It's going up from 1% to now 1.8, 1.9%. That's freaking the market out. But again, I mentioned in my Outlook webinar that if you look at it historically, the rising 10-year interest rate has been bullish for the market as well. Take a look. Again, the blue line is the 10-year treasury yield or 10-year bond interest rate. Take a look. When bond yields rise, stock markets go up. Bond yields rise, stock market goes up. Bond yields rise, stock market goes up. Bond yields rise, stock market goes up. Now people are freaking out. They say, hey, but the yield is going up like crazy, right? See, the treasury yield went up from 0.6% to now 1.8%. What the hell is 1.8%? 1.8% historically is still really low. Now, if you take a look at it back in 2018, the 10-year yield was 3.3%. We're now only at 1.8%. People are freaking out. It was at 3.3%. In 2013, the 10-year yield was at 3% as well. So the 10-year yield is not high. Okay? So why is the market going down? Why is the market crashing? Not because of this. This is being used as the boogeyman. Is being used as an excuse. But the reality, like I said, market is being freaking manipulated. I keep saying this again and again. The stock market is like a bus. All right? As the bus goes uphill, more and more people climb on the bus. Now, once there are too many people on the bus can't go up no more, right? It gets too heavy. So what must the bus driver do? The bus driver's got to reverse the bus and swerve the bus and swing the bus, make sure he throws a lot of people off. Now, once enough people get thrown off, the weak hands, the weak holders, those that are highly leveraged, those who lose faith, those who are panic selling, those whose stop losses get hit, they all get thrown off the bus. Once everyone gets thrown off the bus and the bus is light again, then the bus can go up. That's what's happening to the markets right now. It's throwing people off the bus before it can go up higher. But again, for it to go up higher, again, this applies only to the index itself and profitable businesses that are fundamentally good. I keep repeating that. Again, if you're holding to companies that are not making money, fundamentally weak, it may never come back, okay? Now, again, so what I'm saying is this. Do not fear the interest rate hike cycle, because historically, rising interest rates are bullish for the stock market. Here's a closer look at this fact. So these are all the Fed rate hike cycles over the last 70 years. And you can see again, 1954 to 1957, the Fed raised interest rates, right? Fed rate hike cycle, 58 to 59, 61 and 66. So these are all the periods when the Federal Reserve raise interest rates, like what they're doing now, or what they're intending to do. They've not even done it yet. They're gonna do it soon, right? And if you take a look at all these periods, you can see the average annual return of the S&P 500 has been majority positive. Now, again, it's not 100% positive, but majority of these periods have all been positive. And during these rate hike cycles, the S&P has risen an average annualized return of 9% a year. So once again, there's nothing wrong fundamentally with the economy. The economy is doing really well, and there's nothing wrong fundamentally with the majority of profitable businesses. Microsoft, Apple, and Google, and Facebook, and Adobe, they are the same company they were a week ago, a month ago. So why the heck's the price down 20-30%? Because I keep saying that in the short term, stock prices can be totally irrational. Stock prices are not affected or not driven by the fundamentals of the underlying businesses. But in the short term, prices are driven by manipulation and emotions. For example, did you know that 80% of the buying and selling in the markets every day are not done by human beings? No. 80% of buying and selling in the markets every day are done by machines, by high-speed algorithmic computer machines. And these machines buy and sell without taking into account the actual value of the business, without looking at earnings or anything like that. They buy and sell purely based on calculating the probability of short-term price movement. And that's why, again, a great company can have the share price drop 10, 20, 30% in the short term, although the business itself, nothing has changed. Now, is that good or bad? I mean, say that's not fair, that's bad, right? No, to me as an investor, that's good. I love it. Why? Because this kind of crazy irrational volatility creates short-term opportunities, because it creates mispricing. That a company like Adobe that's worth, say, $600 could temporarily be selling at $400. So if you know what it's really worth, instead of complaining that the market's manipulated and bitching and all, don't bitch, don't complain, take advantage of it, all right? Take advantage by, buying shares of these companies when they are irrationally priced. So again, remember, what you're seeing now, these ups and downs, don't freak out. It's a lot of market maker manipulation. It's a lot of all these machine algo trading. Now, at the same time, what's happening as well? A lot of people, they could be highly leveraged. In other words, they borrow a lot of money to buy stocks, and you should never do that, okay? And once the market drops the way it does, what's happening to these people? They are being forced to sell because they can't meet their margin calls. The broker is saying, hey, put in more cash to your account. They say, hey, I've got no more cash. And the broker causes them or makes them force sell their positions. And so by force selling their positions, that creates even more selling, and that creates that waterfall cascading effect where prices drop like a stone. And of course, a lot of people, what they do is, traders, they have stop losses in place. So the moment the price drops below a certain support level, drops below the 200 moving average, it triggers their stop loss, creates even more selling. So it's kind of like, again, a domino effect that causes the whole market to go down. But once the market flushes out all these weak hands, it flushes out all these retail traders, then hallelujah is going to go up again. Again, only the good companies, only the index. So the good news is that the bull market is still alive, and there's no signs of any kind of recessionary bear markets on the horizon for now. Of course, unless Russia attacks Ukraine and that triggers World War III, or China attacks Taiwan, triggers World War III, or the aliens land. I mean, shit happens that we can't predict, right? But for now, based on the current economic scenarios, we still are in a bull market, and the economy and companies are growing and are strong. So that's the good news. Now, the not so exciting news is that expect a lot more volatility this year. Now, why? Now, again, we can't predict the future for certain, right? But we can look at history. Now, history doesn't always repeat, but it kind of like rhymes. And there are two patterns in history that suggest that the rest of the year is gonna be as volatile. So, fasten your seatbelts. Now, why do I say that? So let's take a look at two of these patterns. Now, as you guys know, this year, 2022, is the US midterm election. So it's important to look at all the past years, what happened to the stock market during midterm election years, to kind of like guess how this year would play out. So let's take a look. So you can see that since 1950, so that's about 70 years. Yeah, 70 years, right? The S&P 500 has tended to pull back during US midterm election years. Okay, so take a look at all the midterm election years, and you can see that during those years, the S&P has averaged an intra-year pullback of 17%. Ooh, what does that mean? That means this year, expect the market to drop an average of 17% from the highs. Okay, so far the S&P 500 is down 13%. So we may not be at the bottom yet. We may not be. So I'm not surprised if it drops another 4%. Maybe not now, maybe later part of the year. But the point is this, expect we could go down 17%, up to 17%, woo, during the course of this year, based on this pattern. But here's the good news. The good news is, based on this pattern, while the market tends to drop an average of 17% during the year, but in the last 3 months of the midterm year and the first 2 quarters of the following year, it's one of the most bullish in history. The market averages a gain of 32.3%. And you can see from the charts over here, source courtesy of Bloomberg. So in other words, what does this mean? This means that if this year is like the other midterm election years, what you can expect is from the start of the year to the end of the year, the market's going to be really volatile, okay? And it could drop, okay, an average of 17% from the highs. And again, we are already down 13% so far, right? But what tends to happen is the last 3 months of the year, hallelujah, it will rally strongly and end the year with a gain, and the next 2 quarters of the following year, which is 2023, whoa, is going to be the strongest bull market in history, or one of the strongest bull markets in history, right? Such that this run is going to be an average of 32.3%. So good news is that, like I said, we're in a bull market, but you gotta be psychologically prepared for the short-term volatility. Now, again, instead of bitching, why is this happening, right? Use it as an opportunity. Use it as an opportunity to pick up shares of great companies that are going to be on big discounts. Now, they are already on big discounts, but you could get even more discounts along the way. Now, we can never pick the exact bottom of a correction. Okay, so you can never buy all at the bottom. And so I tell my students, buy in tranches, nibble a bit, just buy in stages. So you buy a bit, it goes down, you just buy a bit, just buy them. So you average out, okay? So don't expect an exact bottom. So that's the first pattern to be aware of. Now, the second pattern is this. I did mention that last year, 2021, we had altogether 10 corrections in the market, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 corrections last year. But they were all shallow corrections. Shallow corrections. Because most of the corrections last year were between 3 to 6%, right? In fact, most of them were less than 5% correction. So we call last year a shallow correction year. Now, question, what tends to happen the year after a shallow correction year? Let's take a look at history. So again, going back 70 years, since 1955, well, close to 70 years, all right, there were 10 years with such shallow pullbacks like last year. So what tended to happen the next year? Okay, so here's the statistics. Stocks tend to rise the following year, which is this year, but with much higher volatility again. Oh, all right. So again, what they found from this research, again, the source from Bloomberg, is that the S&P 500 tends to average an intra-year volatility of 13% the year after a shallow pullback year. So in other words, based on this statistic, expect this year the intra-year volatility to drop 13%. Now, based on the other pattern, that was 17%, and this one is 13%. So which is it? Well, I would say between 13 to 17%, right? Based on this pattern. But the good news is that the S&P 500 tends to end the year with an average annual return of 7% at the end of the year. So that's why I keep saying that I expect that this year we're going to end up positive as well, but not that much, probably single digits. But during the year, expect really big volatility, market dropping 13 to 17%. Another interesting thing that I thought I'll share is something which I learned from Larry Williams. And Larry Williams is a legend. I mean, this guy is the best technical chartist in history, and he's been in the markets for the last 60 years. And one of the things that I learned from Larry Williams is the decennial stock market pattern. Okay, so what Larry Williams does is he looks at all these historical patterns, right? And what's interesting is that if you look at all the years ending with 1, like 1951, 1961, they have a certain pattern, right? And all the years ending with 8 and so on and so forth, right? So this year is 2022, so ends with a 2. So Larry Williams, he shared what happened in all the years ending with a 2 by taking the average pattern of all those years for the last so many years, right? So this was the pattern that he shared, which I thought was pretty interesting. Now again, I wouldn't say it's 100% accurate, but it looks interesting, so I'll talk a bit about it. And you can see that based on his analysis, years ending with 2, you find what happens during the first 3 quarters of the year. That's right. The market tends to be extremely volatile. All right. But again, the last quarter, hallelujah, it will rally strongly. So what I find interesting is that his decennial stock market pattern tends to fit the pattern of the US midterm election year and fits the pattern of the year after the shallowest pullback year. So 3 things are saying the same thing. Will it come true? Who knows? But there's a high probability. Now, some of you may be saying, hey, but Adam, from his pattern, it shows that after January, like this is January, right? It's going to go down even more. You know, in January, we're already down 13%. Are you saying we're going to drop another 13, 20%? No, that's not what it means. So if you take a look at this pattern, you can see that based on this historical pattern, the market dropped from about a baseline of about 100, okay, down to about a baseline of about 89. So the historical pattern suggested a drop of about 13% here, right? But what's happening this year is in January alone, we are already down 13%. Right, so not every year is exact, right? So what could happen is after this 13% drop. We could be chopping around, and then, whoa! Well, let's see if it happens, okay? So once again, if you're holding to great businesses that are fundamentally strong, that are profitable, don't worry about it, right? Don't worry about this short-term volatility. In fact, take advantage of it. If you've got spare cash, add to your positions whenever you see it getting really undervalued. Because again, in the short term, the market is irrational. The market is not driven by fundamentals, it's driven by manipulation and algorithmic trading. Instead of bitching and complaining about it, take advantage of it. I keep saying that it's not what happens to us that determines our success or failure. It is how we choose to interpret it and what we choose to do about it that determines our success and failure. And I believe in turning any adversity, any challenge into an opportunity. And again, if you have cash waiting to invest, you've not bought anything yet, here's a great opportunity to again start nibbling at fundamentally great companies. So hope you enjoyed it. I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.